post-congressional hearing and combined with a remarkable Q1 2018 result in Facebook's FB shares have rallied more than 15% in the past several weeks. However, in spite of this strong rally in its shares, I argue that Facebook still offers investors a remarkable investment opportunity, as Facebook looks to ways to broaden its revenue stream. Q1 2018 CEO Zuckerberg has made it quite clear in the past several quarters that Facebook's mission is to enhance users' meaningful interactions, and that Facebook is not solely focused on just passive consumption or time spent on Facebook. Furthermore, its earnings call highlighted how Facebook will be spending the rest of 2018 in investing to keep users safe, which one would expect to hear after Cambridge Analytica fiasco. However, Facebook also laid out its future growth prospects. Essentially, one area that Facebook will be investing significant portions of capital will be Facebook Watch. Presently, this is an insignificant portion of Facebook's advertising revenue, but it has a strong potential to make Facebook's ecosystem even stickier for users. Facebook Watch. Briefly, this is how Netflix, NFLX, accounts for its content. Netflix capitalizes its content investments and then plays around with its depreciation schedule in an effort to arguably inflate its profitability and please investors. However, no such accounting maneuvers are necessary from the money-making machine which is Facebook. Facebook has opted to expense its content investments straight through its P. Rather than discuss who is right in its accounting treatment of content, we'll just take it as it is, and understand that Facebook's investment in content together with increased investments in safety and security, as well as other long-term innovations, caused Facebook's Q1 2018 gross margin to jump YoY by nearly 15%. Source: Cost of Revenue, Investor Presentation. Facebook's 2018 investment into safety and security is potentially done in response to the fallout from the Cambridge Analytica scandal. Having said that, with this portion of its full-year 2018 elevated investment accounted for, I suspect that Facebook's medium-term ambition to invest heavily in content is possibly responsible for Facebook's revised FY 2018 expense guidance being up to 50% to 60% compared with its previous estimate, which included a slightly lower range of 45% to 60%. However, Zuckerberg made it clear on the call that Facebook is not attempting to go after the same market as YouTube, Google, Goog. Also, while not explicitly mentioned, but Netflix was obviously alluded to. Although, Zuckerberg described Watch's opportunity as very different from these two platforms. That these platforms are more tailored towards passive consumption, but that Facebook is more interested in ways that Watch can help users connect with each other and share a meaningful experience. More specifically, Zuckerberg highlighted how through Watch Party, users can interact by watching the same videos, and that this is something that Facebook can uniquely offer and build upon. Again, although Watch is presently still small, in the event that Facebook's ambition delivers a strong performance, shareholders would be nicely rewarded over time. Although currently investors are not being asked to pay for this opportunity, readers should in fact think of it as icing on the cake. Valuation. I follow many tech stocks, and Facebook presently offers one of the best risk-adjusted opportunities. Whereas most tech stocks are arguably in bubble territory, Facebook is actually trading cheaper than its own historical average. Readers might be quick to comment that Facebook was a good opportunity a few weeks ago, but where was I a few weeks ago? Well, on the 9th of April, I was as close to the stock's trough as possible, and I wrote an article titled, "Act Now" on Facebook ahead of Zuckerberg's congressional hearing. Having said that, focusing on small-term price fluctuations, while interesting, truly miss the big picture. In fact, whereas many of Facebook's competitors are growing at strong clips, very few of them are successful in monetizing each opportunity available to them as Facebook is. Obviously, no company is perfect. Facebook also has had a few mishaps, potentially Oculus being one. Source: author's calculations. Morningstar.com. As the table above highlights, currently, investors are asked to pay 12.6x Facebook's P/S ratio, which is less than its own 5-year average of 16.6x. Furthermore, on a P/cash flow ratio, Facebook is also trading at a discount, at 20.5x versus its 33x P/cash flow for its own 5-year average. Note: these are not earnings multiples, but tangible cash flow multiples. Given that Facebook is so efficient at turning revenue into cash, it should be little surprise then, that its balance sheet is so strong. Financial position: Facebook has arguably one of the cleanest balance sheets around. Whereas Netflix supports its use of free cash flow through debt raises, and then bullishly highlights its precarious financial position with statements such as, "Our debt levels are quite modest as a percentage of our enterprise value." Netflix Q1 2018. Facebook actually has no balance sheet debt and close to $44 billion in cash, making it by far the safer balance sheet of the two companies, regardless of what Netflix might spin. Takeaway: Facebook presently offers investors a great long-term opportunity, but shareholders are not being asked to pay up for it. Facebook continues to have strong growth opportunities available, such as Watch, combined with a strong core advertising platform which delivers high ROI for advertisers, as well as a management team who know how to successfully monetize opportunities. Disclaimer: please do your own due diligence to reach your own conclusions. Note: the only favor I ask is that you click the follow button so I can grow my Seeking Alpha friendships and our deep value network. Please excuse any grammatical errors. Disclosure: we have no positions in any stocks mentioned, and no plans to initiate any positions within the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from Seeking Alpha. I have no business relationship with any company whose stock is mentioned in this article.